Joining us from Barclays is Michael Pond. He's the co-head of U.S. interest rate strategy at Barclays Capital. He's joining us from their offices in New York. Michael, these levels being hit in the 10-year note yield, is this just about fear, about Swiss intervention and money trying to find the safest haven it can?
So today's move is really about two factors. First is a catch-up to what was going on in Europe yesterday, where the risk assets were for sale yesterday on news coming out of Germany that Merkel's support is dwindling, and so that puts the ability for Europe to do more to help the peripherals at risk. The market's also just following through on Friday's move, where it started to price in a pretty definitive action from the Fed at the upcoming September 21st meeting, where right now the de facto additional stimulus the market is pricing in is Operation Twist, where the market's saying that the Fed will sell shorter securities and buy longer-end securities, which is why we're seeing three-year rates move higher, but long-end rates move sharply lower.
You're saying this is a catch-up trade today. What's the forward trade in a week where we do expect a fair amount of news out of Europe and that jobs plan to be announced by President Obama on Thursday?
Right. As far as the president's speech, he really has to announce something that the market thinks will likely get through Congress. So he could announce some programs that everyone thinks will work, but if they don't get passed through, then they don't matter. And so, we really have to see something that the market thinks will actually get passed. But that's what the market's looking for right now. So, the 10-year rate is not justified by the economic data that's been coming in. It's been weak for sure, but not enough to justify 10-year rates below 2%. But what the market's pricing in is just tremendous amount of uncertainty and the lack of ability right now for monetary or fiscal policy to matter.
Did you think that this 10-year note yield was unjustified before we saw that non-manufacturing ISM figure cross better than expected at 10 a.m. today?
We did, as you mentioned, it was better than expected, and so yields should be heading higher, and yet we're not really selling off all that much, which tells you that it's not about economic data, which actually has been mixed. So payroll data came in and flat, definitely a disappointment on Friday, but ISM survey last week, consumer spending last week were all to the upside, as was this morning's data. So the market isn't focused on the data so much as the uncertainty that's out there and whether the Fed, even if it adds another round of stimulus, will actually have any impact on the real economy.
Right. They're looking more at the forward-looking data here, or looking at the fear in terms of Europe.
That's right.
Looking at the difference between the 10 and the 30-year notes right now, the argument is that it is not indicating recession. What does the bond market know right now that perhaps economists are playing catch-up with?
Well, the people who try to rationalize no recession are looking at the slope of the curve, but forgetting at how low rates are. So a 10-year rate below 2%, it's hard to say that's not the market pricing in a recession, even though the 10s 30 slope is nicely over 100 basis points, about 130 and then some. So, despite the steep curve, the fact that the Fed is keeping short rates at or near zero for likely the next 2 years, the curve indication is something that should go out the window here. It's more about the level of rates in this environment and how low the market is pricing in Fed funds all the way out the curve.
Yeah. Thank you so much, Mike, for making time for us today.